Welcome to Bloomberg ETF IQ. I'm Katie Greifeld. Scarlet Fu is on assignment. Let's get to the biggest stories right now in the nearly $19 trillion global ETF industry. We start with stocks dipping a bit as we start December. Traders shunning some of the riskier corners of the market amid a sell-off in crypto. Plus, Goldman Sachs will pay $2 billion to buy issuer Innovator Capital Management, which specializes in defined outcome ETFs. And we'll discuss the boom in Muni ETFs with Eric Kazatsky of MacKay Municipal Managers. As always, Eric Balchunas from Bloomberg Intelligence. He's here with us now. He's looking at the flows. Eric, what do you got?
Katie, thank you very much. And look, I know the market feels a little toppy. People are nervous heading into the end of the year. Will there be a Santa Claus rally? All I can tell you is that the ETF investors are gung-ho. Look at these numbers here. VU with $4.3 billion. VU is now at $124 billion year to date. No ETF in the history of mankind has taken in that much in a year, and it still has a month to go. Pretty ridiculous. IWM, look, somebody's going to try to make IWM and small caps happen again. We'll see if the 35th time is the charm. Doubt it, but we'll see. IVV also, again, S&P 500, the Qs. And then this is a growth fund. This is junk bonds, and that's the Dow. So a clean sweep of bullish equity sentiment here. So investors might not be nervous, but we'll see. You know, again, the market has gone up a lot. Let's look at the outflows. And there is a little bit, SPY coming out here, $5 billion. Qual, this money went into momentum. So BlackRock's model went from quality to momentum, which is interesting. Now, there is some money coming out of semis here. This is a triple leverage semi, and that's regular semis. So money coming out of that trade, a little bit out of financials, a little bit out of value. And here, a little bit out of cash. That's good. This is a treasury fund. So I'd say net pretty bullish, all things considered. Now, all this money going into ETFs, let's look at the scene in mutual funds, because I think it's important to sort of like see where we are. In mutual funds, it's bad, but you got to unpack that a little bit. Here's a look at equity mutual funds and bond mutual funds. This is equities. So you can see it's like every year outflows, right? And this year, man, it is really bad. They're going to see $1 trillion of outflows this year, probably. Right now, $930 billion. December's usually one of the worst months. And this up here is bond mutual funds. So people, they're still eking out inflows, believe it or not, on the bond side. People prefer bond managers in terms of using the mutual fund wrapper. Their Achilles heel, though, is the rates going up. So you can see in 2022 when rates went up, bond mutual funds had their worst year ever. But probably the Fed's not going to raise rates. So they're looking pretty good. So, Katie, obviously mutual funds are part of the reasons ETFs are doing so well, but it is sort of a tale of two asset classes when it comes to their flows.
Absolutely, Eric. Let's keep this conversation going now with Brittany Christensen. She is SVP over at Tidal Financial Group, joining us on set. Great to see you in person, Brittany.
Hey, great to see you. Thank you for having me.
So let's talk a little bit about that chart, because it's a story we know well, right? You have mutual fund industry-wide outflows. You have a ton of money pouring into ETFs. That's been the story of the past decade. The story might get a little bit more interesting or supercharged, depending on where you fall, when it comes to 2026, with the introduction of multi-share classes, the ability for asset managers to launch ETF share classes of their existing mutual funds. This has been talked about as sort of a big bang moment, a Y2K moment, whatever you want to call it. I wonder how you're thinking about it over at Tidal.
Yeah, absolutely. So I think a lot of angst has been built up around this. In fact, we started to see mutual fund conversions pretty much dry up. All of the conversations we were having about that sort of evaporated as everybody was waiting for share class. I think share class had a lot of ambitions to solve a lot of problems, and I think it solved some of them, but maybe not all of them. And so I think there's still a long way to go. And I think there's still some key challenges facing most mutual fund managers. But look, Tidal has, filed for the exemptive relief both ways. So we also see opportunity in ETFs launching a retirement class, for example.
Well, Brittany, to that point, we had Holly Framstead of Capital Group on the show last week. Let's listen to a little bit of what she had to say.
We just think that the existence of the ETF share class isn't necessarily going to be the panacea that clients expect or are looking for when they're looking to transition to a more tax-efficient solution.
So I think that pairs up well with what you're saying, not necessarily a panacea. Sort of give us the reality versus the expectations.
Right. So the reality is there's still a lot of hurdles around distribution and how different distributors get paid, and that still hasn't been solved. I think part of the impetus of the regulatory approval will force conversations that have always been challenging. And look, there's things that ETF issuers want as well that mutual fund managers have, like access to information about who their investors' bases are. So maybe this is an opportunity for the industry to kind of come closer together on certain things that have been different, like distributors and how they're getting paid, distribution platforms. But there's a lot still to figure out. I think even as far as where the controls are coming from for cross-share class subsidization, those are the types of things that I'd be paying very close attention to out of forums like the ICI and other industry channels.
How in denial are these mutual fund managers? Because the ETF industry is brutal. I mean, to me, it's the future of the whole enchilada. If you could make it here, you're set for a while. But it's hard.
Yeah.
You've seen, the Fidelity Magellan Fund famously came in and nobody cared. Like, it's not till they got cheap that they started to care. So whether it's the mutual fund share class, adding an ETF share class, how much do they understand that you can't really charge 90 basis points for beta anymore?
Look, I think that's a great question. And it's interesting, even in my seat in business development, I say to a lot of people, look, not every mutual fund should be an ETF. Like if it's not a successful mutual fund, why would you just turn it into an ETF that's going to be harder to be competitive in? It's going to be harder to charge the fees that you might be getting today in mutual fund land. Look, I think the ETF does the right thing by the investor. It takes a look at the competitive pool, what other types of funds are out there, and what are they charging. And I think that's the right approach to coming up with a public fund product.
Let me ask you about you're a white label issuer. One of your biggest hits this year is Granny. That's the Tom Lee ETF, which honestly just holds some stocks. I didn't think it would be such a big hit, but obviously his name brand is pretty powerful. 2.7 billion in flows this year. That's a lot. Is that sort of a guiding light for some of these managers? Do they see a Tom Lee making it, Dan Ives, and they're like, hey, I need to be over there? Or is it purely just this structural issue with, hey, we're losing money, we've got to be where the fish are biting? How much is it that sort of Hollywood factor that we're seeing here?
I think it's both. And I think that's what's so interesting. In our seat, we help everybody from an entrepreneur with a great idea that hasn't been brought to market to legacy mutual fund managers who are looking at a big, expensive suite of mutual funds trying to figure out the best place to start, So we help everything in between. I think with Tom Lee and Dan Ives, what you're seeing there is there's big appetite to follow their investment advice already. That's an embedded marketplace for an ETF audience, and I think that's what you're seeing really drive the success in those funds.
And it's going to be interesting, Eric. Ron Barron, his shop, has filed for ETFs as well. One of the tickers, I believe, is Ron B on one of the proposed ETFs. So we'll see if, again, that translates from the mutual fund wrapper into the ETF, Brittany. But going back to, this share class conversation, spinning it forward to 2026, we spoke to NASDAQ on this show as well. And NASDAQ is very much staffing up, trying to get ready for that moment. And I wonder what that preparation looks like at Tidal, because, folks in the industry are talking about potentially hundreds of new ETFs coming into the industry. And, given that you work with so many different issuers, what does that preparation look like on your side?
So we have been staffing up as well. I mean, we've been growing very rapidly. I think we're launching almost 140 ETF products as of the end of this week. So in this calendar year alone, that's up 68% from last year. So a lot of new launches that we've done. I think the industry overall is ready to take on more. I think that the ETF mutual fund conversation will be a lot more about trying to unpick what existing mutual fund infrastructure any given manager wants to maintain or use. So that's what we've been focused on. Historically as a white label, that kind of comes with sort of a predefined, ETF in a box architecture. What we realize is that we have, the capabilities to support ETFs in many different ways on many different trusts. So we started to break out our services a la carte.
I just looked, you guys are responsible for 100-ish ETFs hitting the market this year. That's a lot. Considering it's 940. So you're almost over 10% of all the funds. Now, you're almost like a book publisher. People come to you with pitches, and you only accept some of them.
Yeah.
What percent do you accept, and how bad are the pitches that you don't accept? Because there's so many launches, it almost seems like every idea is hitting market.
Look, I think that there's a lot of factors that go into deciding whether someone should bring an ETF to market or not, and we try to consider a lot of them. When someone comes to me and says, I've got this great idea, large cap, AI focused, thematic fund, that's the most crowded space. I usually turn around and say, do you have, somewhere in the ballpark of 100 to 200 million in seed capital to start this product? Because that's probably what you're going to need to give this thing real legs. So, I think overall the industry has come a long way in the last couple of years. When I first started in this space, you would tell people 5 to 10 million is a good seed number. I think now it really depends on how competitive the space is that you're getting into and what your brand is known for.
Absolutely, Brittany. That's a good place to leave it. Great to get some time with you. That is Brittany Christensen of Tidal Financial Group. Now, coming up, Goldman's big deal. The giant is buying issuer Innovator Capital that specializes in buffer ETFs. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with IBIT. We know that sell-off in Bitcoin is deepening, but an interesting proposal coming from NASDAQ, basically asking to quadruple the daily trading limit for options on IBIT here. So that's the second request, actually, to expand the daily contract. We'll see whether that gets over the line. But let's talk about Bill Ackman, looking to raise $5 billion for a U.S.-listed closed-end fund. We know that this is something that he's tried before. We'll see if this one gets over the line. But this interesting chart from Bloomberg Intelligence, taking a look at fund assets overall, you can see that ETFs sit at about $13 trillion. Open-ended funds, that category includes mutual funds, north of $22 billion, close to $23 trillion that is, and closed-end funds bringing up the rear in a big way. But let's end with Goldman Sachs. Some interesting M&A news out this morning that Goldman is going to buy Innovator for $2 billion. You might know Innovator as one of the leaders when it comes to buffer ETFs. They were one of the first movers there. So let's talk more about this with Bloomberg's Emily Graffeo. And Emily, this is a really interesting one. Again, we're talking about buffer ETFs. They fall into the defined outcome territory. Before we talk about, why this makes sense for Goldman, just give us a little overview of what buffer ETFs actually do.
Okay, so buffer ETFs, otherwise known as defined outcome ETFs, basically limit investors' downside by capping the upside potential. So Innovator launched the first defined outcome ETF several years ago, and most of what their products do is they give investors a little bit of upside. So maybe you get the first 10% of upside in the S&P 500 over a certain time period, and you're shielded against a certain percentage of losses. Advisors love these. A lot of clients in the advisory space are older, maybe closer to retirement, so they want a little bit of that stock upside, but they also want the protection. So Innovator's done a really great job selling these to people like that.
How is this going over? My first reaction was, okay, well, that's why Goldman's been quiet. Okay, that's one. And number two is, good for Bruce Bond, but the valuation was pretty high. You're paying a lot for this revenue, but I do think, like cholesterol, there's good revenue and bad revenue. This is good revenue because it's on the ETF side of the fence as opposed to mutual funds. And it's hard to make 90 basis points with something that's active, and the flows are coming in and breaking records every quarter. So I don't know. It seems like a pretty good deal, but some people said it a little pricey.
Yeah, well, there's not a lot of precedence. Jefferies had a note out. They have a buy rating on Goldman, and they pointed out that the last time we saw kind of a spree of ETF M&A was back in 2017. Invesco had purchased a European firm, and they paid about 2% of AUM. So Goldman's paying about 7% of Innovator's AUM. So that's a premium, but Jefferies did note that these products are specialized, they have that higher expense ratio, so perhaps you pay up for that.
And they're not market dependent, right? They're not like an active fund, like you could have outperformance, all the money leaves, or some theme ETF. These are basically like rain or shine type products that you put in your portfolio for the long term.
Yeah, and they roll over as well, so you can kind of keep a client in the portfolio for a long time. What's interesting is that Goldman had their own lineup of these.
Right.
They had about 3 defined outcome ETFs that they launched this year. they totaled about 36 million in AUM. The total defined outcome ETF space is over 70 billion. So they tried to do this on their own, but they didn't really get a lot of flows.
Yeah, it's just fascinating, the fact that Goldman did try to enter this category, even with the might of the Goldman name and distribution, weren't able to really get significant traction here, instead buying Innovator Capital, one of the first movers in the space. So talk to us a little bit more about those integration and those Innovator employees. They now become Goldman employees.
They become Goldman employees. We're told that they will stay in their Wheaton, Illinois headquarters. Wheaton is a suburb of Chicago that actually a lot of ETF firms are based in. First Trust is another leader in buffer ETFs that's based there as well, Amplify ETFs. So those employees stay there. This is like a sales force of a lot of people that went to Wheaton College. It's a tight-knit community. Bruce Bond at the helm with his co-founder John Southard. So this is definitely like Wall Street coming to Wheaton, Illinois, which is interesting in and of itself to watch. And again, it's a sales force that's really used to these almost niche ETFs. They know how to sell these. They know which advisors to kind of touch to. And Goldman actually said that when we were interviewing their head of asset management. He said Innovator has a track record. They have that strong following. He said the head start does matter in this business.
Absolutely. Emily, great reporting. Of course, we broke that story alongside Todd Gillespie earlier today. And be sure to tune into our exclusive interview with Brian Lake of Goldman Sachs. That's at 3:10 p.m. Eastern on the close. But still ahead on ETF IQ, we're going to drill down into Muni ETFs with Eric Kazatsky of MacKay Municipal Managers next. This is Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time for today's drill down where we focus on one ETF. Eric, what do you got?
Katie, today we're looking at an active municipal bond ETF called the NLI MacKay California Muni Intermediate ETF. So again, this is like a classic bond manager who's out there picking muni bonds that are from California and trying to outperform a benchmark, right? So 36 basis points of a fee. Again, that's pretty good considering it's active. It's going to be lower than most mutual funds. And it has 64 million in assets. Let's look at the holdings here. Again, for most of us, we're not really that familiar with all of these different munis, but you're going to see California. There's University of California, a lot of Cali and Cali cities in there. These are the 108 bonds they picked. Interesting, though, most of the benchmarks have 1,300, so very concentrated, which is good because that gives you a chance to outperform. Let's look at the performance of this versus the BlackRock California Muni and also the MUB, which is just the broad Muni. And you can see this is outperforming over the past 3 years. And it's interesting, you can see how much money you get from the yield. See, that's the price change isn't much. Throw the yield in there, but this is, this doesn't say a lot about tax equivalent yield. If it yields 3.4%, if you're in Cali, you really get more like 7.4% if you include the tax-free part of the Muni deal that you take on. So again, the performance is pretty good, and that's going to help its cause, Katie.
All right, Eric, thank you. Joining us to talk about this ETF is Eric Kazatsky. He is a portfolio manager over at MacKay Municipal Managers. Eric Kazatsky, it's great to see you.
Good to see you.
So let's talk about this ETF because we talk about single stock ETFs all the time.
Yeah.
It's kind of fun to talk about single state ETFs. And just walk us through why California. I have to imagine it has to do with the very high tax rates, but why focus on this state in particular?
Well, you hit the nail on the head, right? If you're top tax earner in California, you're paying 13.3% to the state on top of the almost 40% you're paying to the federal government, right? So you're looking for any ancillary tax savings you can get, and we're filling a need there.
So let's look at some of the bonds in here. I mean, it's kind of like Chinese to me, to be honest. You're the expert here.
Yeah.
What are you looking for when you buy a bond? Obviously, there's duration, credit, or just the that on the ground information about how good the deal is and what it represents. What do you got?
Look, it's going to be all that, right? Like, we're trying to match a benchmark and beat that benchmark, right? So there's going to be a couple different levers you can pull, right? You're going to play with duration and you're going to play with better credit selection. And I think just compared to the competitors you pointed out when you were drilling down, right? It's really just sort of accessing that 25% of the market that our competitors really aren't playing in. That's really led to the returns.
And let's zoom out and talk about Muni ETFs overall, because it's the first trading day of December, and we've been talking about the triple crown that we're seeing for the industry overall, but it's been quite a year for Muni ETFs as well. When you just think about the growth rate, what is driving that?
You know what? a lot of that growth has come in the active side. And to me, that seems that the pendulum is swinging and people care about total return again. So as active managers, that's super exciting. But again, it really goes back to taxes. And people hate taxes. I hate he hates taxes. I know it. So it's really, again, filling that need and sort of checking off a box, but also giving people something tangible. They can point to a school. They can point to a hospital. So it's something they're familiar with.
An advisor once told me that their clients hate taxes more than they like getting returns. Like it's actually more important to some people.
Beating taxes is more satisfying.
Yeah. Anyway, back to active. Yeah. We showed how bond mutual funds, especially active ones, have like survived this sort of like passive massacre that equity is feeling. Yeah. And if you look at the active versus index reports from S&P, Munis are like through the roof. I think 70 to 80% of active muni managers beat their benchmark versus 30 for stocks. Why?
It really comes down to the diversity of credit available in municipals. So you're talking 900,000 CUSIPs, 50,000 different issuers, right? It gives you a lot of room in the sandbox to play in, and I feel like that's where a lot of the active management can really sort of make the differential for clients.
Going back to the idea of state-focused funds, you know, we talk about California all the time. There's a lot of New York-focused muni funds out there as well. Are we going to see that expand to other states, or is it really just those big two that people care about?
Look, there are other single-state mandates. Obviously, because the taxes aren't high in other states, they're not as attractive. But look, if you're a New York investor, there are New York-specific funds. But you could even buy the Cal Fund and pick up 5.5% on an after-tax basis, right? Still attractive no matter if you live in California or not.
Okay, I've always wondered this about the muni category. How come an issuer hasn't come out with the name of the things they buy? For example, the schools and hospitals muni ETF, because who doesn't like schools and hospitals, Katie? I always thought this would be a more natural way to be ESG, but I haven't seen it. It's always like intermediate, it's just, why don't they just talk about what it does?
I think it comes down to diversity in portfolios. Look, I totally get it, right? Schools. It's so easy. What a sale, right? I just invest in schools. But you're not getting the diversity that people really are seeking in the municipal market. They want a broad basket of everything that really is sort of, makes up the market.
And what do you guys have planned next? I know you have rolled out a few products, but you don't like flood the market with products. What do you got planned next?
I think the next thing in line is really an allocation ETF playing in that basket of high yield and IG credit, and really sort of leading into our strengths as better credit selectors.
All right, Eric, we'll keep in touch. We'll keep an eye out for those funds in 2026. That is Eric Kazatsky of MacKay Municipal Managers. And you can read all about this drill down, plus the latest in the ETF industry, when you subscribe to my weekly ETF IQ newsletter. That is Bloomberg.com/ETF IQ newsletter. I promise it's a hoot. It comes out Fridays at about 2 p.m. if I do my job right. But that does it for Bloomberg ETF IQ, the television show. I'm Katie Greifeld, along with Eric Balchunas, and you've been watching Bloomberg Television.